Hi, I'm John Gersbeck, Chief Financial Officer of Citigroup. This morning, we reported our results for the second quarter of 2014. I'd like to take a few moments to go through them with you. First, I'd like to point out a significant item that impacted our results this quarter. Earlier today, Citi announced a settlement with the U.S. Department of Justice, state AGs, and the FDIC to resolve all pending civil investigations related to our legacy RMBS and CDO underwriting, structuring, and issuance activities. We also have now resolved substantially all of our legacy RMBS and CDO litigation. As a result of this settlement, Citi took an after-tax charge of $3.7 billion in the second quarter. We believe that this settlement is in the best interests of our shareholders and allows us to move forward and to focus on the future, not the past. The $3.7 billion after-tax charge had a significant impact on our reported second quarter profit. For the rest of this video, to make it easier to compare our operating results to prior years and quarters, I'll discuss Citi's second quarter results, excluding both the impact of the settlement and credit debt valuation adjustments. Excluding these items, Citi earned $3.9 billion in the quarter, up slightly from the same period last year, as lower revenues were offset by lower operating expenses and a decline in credit costs. Citigroup end-of-period loans grew 4% year-over-year to $668 billion, including 8% growth in Citicorp, while deposits grew 3% to $966 billion. We continue to maintain expense discipline in our core businesses. Legal and related costs were roughly $400 million, mostly incurred in Citicorp, and repositioning costs in the quarter also totaled about $400 million, including $270 million related to our consumer franchise in Korea. However, core operating expenses of nearly $11 billion in the second quarter declined by more than $225 million in constant dollars year over year, resulting from our continued cost reduction initiatives and the decline in Citi Holdings assets. Core expenses were also down versus last quarter, reflecting lower incentive compensation and continued efficiency efforts, partially offset by higher regulatory and compliance costs. Turning now to our core businesses, our international consumer franchise grew revenues 1% from the prior year, with most underlying drivers, including average loans and deposits, remaining positive. Korea remained a headwind. However, with our repositioning of this franchise now substantially complete, we believe we should see sequential revenue growth in Korea as we enter the second half of the year. In North America Consumer, revenues were down 5% from the prior year and flat versus the first quarter. Much of the yearly decline is attributable to lower mortgage refinancing activity. Importantly, mortgage revenues increased quarter over quarter and helped to raise total retail banking revenues by 3%. Branded card revenues rose 3% from the prior year, while retail services increased 7% on the strength of the Best Buy portfolio acquisition. Looking briefly at our global consumer franchise overall, while we've been through a challenging period in North America mortgage and Korea, outside of those businesses, we've made steady progress in improving our operating efficiency, with an efficiency ratio now just under 54%. And we remain on pace to achieve the target efficiency ratio of between 49 and 52% that we established as a goal for 2015. Turning then to our institutional businesses, revenues were down both for the year and sequentially, driven chiefly by declines in our fixed income and equities market businesses due to unfavorable market trends. Total banking revenues, however, grew by 6% year over year and 9% over last quarter. Investment banking posted a particularly strong quarter, largely on the strength of debt and equity underwriting activity. And we continue to increase our share of announced M&A volumes in a growing market. Our TTS business again saw underlying revenue growth as volumes continued to increase. And on a trailing 12-month basis, the ICG has now lowered its operating expenses every quarter for 2 straight years, driving its efficiency ratio from 66% 2 years ago to 60% today. Looking at Citi Holdings, absent the impact of the mortgage settlement, Holdings actually earned more than a $240 million profit in the second quarter, compared to a loss of nearly $600 million in the same period last year, primarily driven by the absence of rep and warranty reserve builds, higher gains on asset sales, and lower funding costs. Holdings ended the quarter with assets of $111 billion, or 6% of Citigroup's total. Finally, Citi's capital and liquidity positions remain strong, with our estimated Basel III Tier 1 common ratio improving to 10.6%, and our supplementary leverage ratio increasing to 5.7%, well above regulatory requirements. And in the quarter, we utilized another $1.1 billion of our deferred tax assets. To get more in-depth information on today's earnings report, please visit Citi's Investor Relations webpage, linked below this video. Thank you once again for your interest in Citi, and I look forward to reviewing our third quarter results with you in October.